So recently it feels like every major tech company is suddenly throwing AI stock trading tools at us. Alibaba, Kimi, Tencent, they are all rolling out these deep research features for retail investors. I mean, we are talking about a massive market here, right around 250 million investors in China alone. But the real question everyone is asking is, can we actually trust an AI to play the stock market for us?
That is the ultimate question right now. Look, it makes sense why these giants are jumping in. AI does have some serious natural advantages that humans just cannot compete with. First off, it has this brutal data crunching power. While a human analyst is physically limited in how fast they can read an annual report, an AI can process a decade of balance sheets, stock charts, and even track the tone of executives in earnings calls all in minutes.
Right, that kind of speed is just insane. And I guess there is the emotional side too, or rather the lack of it. Humans panic when the market crashes or get super greedy during a bull run.
Exactly. AI is completely immune to behavioral finance flaws. It doesn't need sleep, it doesn't have an ego, and it definitely doesn't panic. It just strictly follows its algorithms and probability models. So in a highly volatile market, that cold discipline can actually show incredible resilience. It basically helps level the playing field between regular retail investors and the big institutional players.
Okay, so it sounds like the perfect trading machine. But there has to be a catch. What is the Achilles heel here?
There are actually a few massive blind spots. The biggest one is its obsession with historical data. AI is trained on what happened in the past, so it remembers history, but it doesn't really understand the future. If a totally unprecedented geopolitical conflict happens or a massive policy shift drops, the AI's historical models can instantly fail. We call this the risk of model overfitting.
And what about AI hallucinations? We have all seen AI make up random facts in casual chats, but if it hallucinates in the stock market, that is real money on the line.
That is exactly what makes it so dangerous. If an AI writes a funny poem, no harm done. But if it invents a fake positive earnings report or misreads a regulatory policy, the financial hit is devastating. And worse, if millions of people are using very similar AI models, they might all get the exact same buy or sell signals at the same time. This creates an algorithmic herd effect that could easily trigger flash crashes.
Wow, so an entire market crashing just because a bunch of AI bots decided to dump a stock simultaneously. So where does that leave the everyday investor? Are we supposed to just ignore these tools?
Not at all, but we have to redefine the relationship. The golden rule is this: treat AI as your personal investment assistant, not your investment guru. Let it do the dirty work. Let it scan the market 24/7, summarize hundreds of pages of boring reports, and monitor social media sentiment. But the final buy or sell button, that decision must stay in your hands. You have to combine what the AI finds with your own risk tolerance and your read on the macro environment.
Love that. Let the AI do the heavy lifting, but keep the steering wheel in your own hands. Don't become a puppet to the algorithm. Thanks for breaking that down for us, and we will catch you all in the next episode.